In this video I will talk about a subject that seems to confuse many traders, which is what exactly they should do to determine the dominant player in the particular market being traded. The vast majority of traders call this process the trend identification, which is basically the same thing. If you have been a student of the fractal flow method or you watch the free videos of this channel, you are aware that if you attempt to derive the overall trend of the market from indicators you will be disappointed. The reason for that is that most of the time, indicators blur the important details that can tell you who is in fact in control of the market you are trying to trade. Here in the Fractal Flow channel we use undeniable facts on the chart to pinpoint the delicate relationship between buyers and sellers. This is definitely the most difficult part of any analysis. It's far more difficult than drawing good lines or identifying different types of divergence, for example. For this reason, we have to use highs and lows as our primary source of information to determine the trend of a market. Keep in mind that the trend of a market is sometimes very quick, and it can change very rapidly. When we think about a market trend, we tend to think about a movement that lasts for very long, but that's not always the case. Beyond that, we have to use highs and lows in context, and I will try to explain more clearly what that means in practical terms. In any timeframe you will be able to find at least two sets of highs and lows or two fractals. You will be able to call the larger one the major flow and the smaller one the minor flow. This is important because these two forces are always colliding with each other. Sometimes they agree and sometimes they don't. When the major and minor flows don't agree about the direction they are trying to go, it's difficult to find a trade opportunity. The first and most important step of every market analysis is to mark out the major and minor highs and lows of the chart you are trying to trade. This might seem overly simplistic, but it's the absolute basis for the rest of your analysis, and without this step, the rest of the analysis will simply not work as it is supposed to. Keep in mind that two different traders might mark out major and minor highs and lows in slightly different ways. This is why this is a subjective process. One of the challenges you will find when attempting to mark out highs and lows is that sometimes it will not be so obvious which of the market extremes belong to the major flow and which belong to the minor flow. That's precisely the reason this is a subjective process, because traders differ in their perception about this, and both can be right simultaneously. The basic rule to determine a trend is that when you have higher highs and higher lows, you can assume that buyers are stronger than sellers, and when you have lower highs and lower lows, the sellers are stronger. Let's think about this for a moment. When price is creating higher highs and higher lows, it means that buyers are strong enough to create higher highs and that sellers are not strong enough to stop the higher highs from being created. By the same token, the higher lows are created because buyers are able to take control from the hands of sellers before they create a low that is low enough to break the notion of uptrend. The opposite is also true for the downtrend, of course. The problem really begins when you have a major flow in one type of trend and the minor flow in the opposite type of trend, and it's not clear which one is the major and which is the minor. At this point you might be thinking that it could be better if you simply use a moving average to see the trend of the market because it's a much simpler way of tackling the problem. You need to be very careful about this idea for a few different reasons. The first is that this impulse to make things simple is a biological intuition that is very well documented by science, and it exists for reasons that have nothing to do with our modern life. We inherited this bias from our ancestors who could actually benefit from this impulse, but our society has a completely different level of complexity nowadays. In other words, trying to maintain things simple only works for things that are actually simple as well. If you try to simplify a complicated thing, you will risk erasing and purposefully ignoring important details about this thing. This is exactly what happens in trading. People get overwhelmed by how tricky a good analysis can be because they are attracted to the idea of trading in the first place because it seems simpler than other entrepreneurial endeavors. Let's also remind ourselves that simple does not mean easy. There can be multiple levels of difficulty in a simple task. One very good example of that is this idea of marking out highs and lows in the chart. This is a very simple way of starting the analysis, but it is just the start, and the conclusions you have to make from this point onwards get trickier as the analysis advances. For example, if you want to win a soccer championship, all you have to do is to win the final game. That's an answer that encapsulates everything you must do to win the championship. However, there are many things buried in this answer because to win the final, first you must get to the final game. To get to the final you must have a team that is good enough to score enough points and win enough matches. That brings us to the notion that you must have a team that is good enough to do that, and this is a statement that has even more assumptions buried into it. A good team is formed by good players that are not only good individually but are good at articulating themselves as a team after all. This is obviously a complicated thing that cannot be reduced to a formula. However, if you want a formula, you can have one. All you have to do to win the championship is to win the final game. The essential point here is that you have to start with basic assumptions and then dig them to see what they truly mean. What I want to do in this video is give you a set of starting points that are simple so you can start your analysis, but then you will have the responsibility of digging into these simple rules to extend the analysis up to the point where it becomes good enough so you can use it to actually trade the market. Starting the analysis is also a bit difficult, so here are a few things you can do to make your life easier and more realistic. The first thing is that you should pick one market and one timeframe only. Forget about everything else for now because it will only serve as a distraction to you. Pick one market and one timeframe only and don't look back to see what other opportunities you could have taken hypothetically. That's a useless exercise to say the least, and it only pushes the problem into the future and keeps you trapped. The second thing is that you should start your analysis with a reasonable amount of price information in the chart, roughly speaking. If you don't know what that looks like, then simply take a look at the live trade examples I uploaded here in the channel and you will have a pretty good idea of what this amount of price information should look like. If you use too much price information, you will become overwhelmed. If you don't use enough price information, then you will not have enough details to understand the context of the market. Once you solved the problem of which market to trade and how much price information you should use, then you will have to begin the analysis itself. The third thing you should do is to mark out the highs and lows on the chart. Here is where it begins to get tricky. You have to first mark out the price extremes in what appears to be the major flow, and then you have to do that with the price extremes that seem to be in the minor flow. Once you have that, you can move on to the fourth step, which is to decide who is in control of the market in the present moment. If the market is producing higher highs and higher lows, then we have an uptrend, roughly speaking. If the market is making lower highs and lower lows, then we have a downtrend. However, this is not so simple because you have to consider the trend of the major flow and the trend of the minor flow. You also have to decide which market player is accumulating energy, and which one is exhausting its energy, and where the points where this behavior is likely to reverse are. These are your basic starting points of the analysis. If you do this successfully enough, you will have a very good foundation for the easier parts of the analysis, like deciding where the important support and resistance levels are, and the momentum analysis as well. These are basic starting points, of course. If you want to understand these things in greater detail, you can check out the Fractal Flow Strategy video course where I go much deeper into these things and many other relevant things about trading as well. This should give you a good starting point. If you enjoyed the video, please click the like button, subscribe to the channel, and leave your feedback below. Thank you for watching.